Happy Friday, everybody. I would like to talk a little bit about my investment in Palantir Technologies. Those of you who follow my channel probably see this in my value portfolio and wonder, what the heck is this company doing there? Doesn't pay a dividend, doesn't have a PE as of yet, only has 1/4 of positive net income and maybe like a year of positive free cash flow. Well, let's get into that just a little bit. Palantir is a company that was really the talk of the town back in 2020, 2021, when it was, anywhere from $20 to $30 a share for much of that time. My own personal view at the time was it was too early to really count your chickens and jump in on this, because it remained to be seen how much growth they could, sustain. Remained to be seen whether they would, go from negative to positive on their net income or their cash flow. And I just wasn't comfortable at those high prices, relative to their financial performance. Now, interestingly enough, last fall/winter, the share price fell and flirted with some very low lows. Okay, we're talking, about like an 80% collapse in the share price or something along those lines. At the same time, they were starting to show signs of positive free cash flow, positive net income. And suddenly, my value radar started tingling a little bit, so to speak. Okay. Now, Palantir is, as some of you probably already know, a technology software business. Now, the interesting thing about them is that they seem to more go after the big fish. Okay, they like to solve big problems for governments and big businesses with their unique software and ability to analyze large sets of data. Now, a business like that, it costs a lot in terms of doing the development of the technology itself, as well as retaining talent, etc. But the fact is, once they've already got their software and their products developed, the gross margin on every sale is going to be tremendous. Okay, so if you take a look at their financials, you can see their revenue, which has been growing nicely. But the thing I want to call your attention to is the gross profit, okay? In 2022, $1.9 billion in revenue, almost $1.5 billion of that was gross profit, okay? You're not going to see like a consumer staples company put up gross profit numbers like this. And with the high degree of revenue growth, it means that more of each dollar of revenue becomes gross profit, right? We're talking like 75 cents of every dollar becomes gross profit, which means their ability to grow then the bottom line as time goes on should be better. Okay. Now, granted, we're still seeing net loss, but the net loss has decreased substantially. In fact, in the most recent quarter, instead of a net loss, they actually did have, even though they had a net loss for the trailing 12 months, that last quarter of 2022 did have $30 million of net income. And for 2022, free cash flow was something like 9 cents per share. Now, it's really difficult to calculate a future value of this company based on a DCF calculator, mainly because you do not have a lot of historical financial information to go off of. All right. So in the DCF calculator, what I've done is I've assumed already that they would increase the free cash flow several fold in the next, call it couple years, from 9 cents to maybe something like 36 cents. Now, this is sort of an out of the air number. It's one that I think is probably somewhat realistic based on, how quickly they've grown revenue and at the rate at which they've gone from negative net income to positive net income and positive free cash flow. I think if the trajectory continues for another year or so at a similar pace, that it's a somewhat realistic number. But keep in mind, it is still speculation on my part, okay? Keep that in mind. And I've also decided to give them credit for their tangible book value. They got a lot of cash on hand, etc. And they have diluted before, which I don't blame them for when their stock was when their company was making no money, their stock was $20, $25, $30 per share, and people were just happy to pay that. Don't blame them for raising money that way, rather than taking on debt. So we're hoping that dilution will stop now that net income and free cash flow have gone into the positive. And so here we go. So assuming that we're starting from an annual free cash flow of 36 cents per share rather than the current 9 cents. So we would hope that it would play out this way sometime relatively soon. We would then assume potentially a slowdown, right, in their growth rate. I'm thinking for the following 10 years after that, slowing down to something like a 9% growth rate, which, by the way, is less than what they have done, but we don't have that much history to go off of. So that, again, is just, sort of a number I think is somewhat realistic, maybe even a little conservative, honestly. I think there are people who would say I'm way low on that number, but, I'd rather be a little bit more conservative than the crowd because, again, I'm putting money into something that's somewhat speculative, doesn't have really all that much of a track record, okay? Well, when you do that, you do see that the fair value, assuming, any of these numbers are more than just nonsense, would come out to something like $7 a share, today to get a 10% return. Now, I personally got assigned in the $6 to $6.50 range on the 100 shares I do have. So I got it at a little bit of a discount to what this fair value number reflects based off of these assumptions. However, I cannot stress this enough. It's a less than 1% position in my portfolio because of the fact I have to make so many aggressive assumptions about what they will do in the future, and that they would have to execute perfectly to get there. Things can go wrong. They don't have much track record yet. Anything can happen in the future. So I'm tempered and, keep it as a proportionally small position to be consummate with the risk. Companies with more track record that I've seen what they can do, that I'm more sure of, will be higher percentage positions in the portfolio. And I hope that makes sense. The more assumptions, the more conjuncts, the more things that you have to assume that they would do in the future rather than what you're basing off of track record, I think the more risk, the more uncertainty, and the more conservative you should be with your position sizing, in my personal opinion. That's what I practice. So take with that what you will. I would appreciate you all letting me know in the comments below what you think of Palantir, and join the Discord if you want to have a dialogue about it. Subscribe to the channel if you wish to be a part of the conversation in an ongoing basis, and have a wonderful weekend, everyone. Cheers.